Hello, I'm Brian Lucareli, Director of our Private Client Services Group and co-chair of our Family Offices team at Foley and Lardner. And today I'm here with Tim Voigtman, partner and co-chair of the Family Offices team, along with me. Before I ask Tim to give a brief introduction, today's topic we will discuss developments regarding entity level taxation. So Tim, if you wouldn't mind, could you provide a little background for the viewership so they could get a sense of who you are? Thank you.
Brian said, I'm Tim Voigtman. I am co-chair of our tax benefits and estate planning group here at Foley, and I do put an emphasis on closely held, family-held businesses and family offices. In particular, I focus on the tax side of things, generally income tax matters, but do cover a whole host of other issues related to family offices.
Good. Well, thank you, Tim, for a little bit of that background. So what I thought we'd do today, I put together probably 3 different questions, and I'm going to try to tap into your insight and expertise. And you can share that with the group. So if I can, I'm going to start out with the first one. And the first is, and again, our topic is regarding entity level tax selection, but the 2017 Jobs Act imposed a $10,000 limitation on the deduction for state and local taxes, the so-called SALT limit. That provision is set to expire in 2026, but recent proposals in Congress have suggested that the SALT limit may be extended as part of further tax bills. With such a long time horizon in mind, what have states done to help minimize the impact of the SALT limitation?
Sure, Brian, that's a great question. A number of states have adopted legislation that allows so-called flow-through entities, generally partnerships and S corporations, to elect to pay state income taxes as an entity-level tax. So an electing organization decides, please tax me at the entity level, and then there is a corresponding exclusion from income or credit that is given to the individual members or partners or shareholders of the flow-through entity on their individual returns that either partially or fully alleviates their state filing obligations. For example, the state of New York has an election where if you make the election, you pay at the entity level, and the individual partners would not pay anything at the individual level. Accordingly, it in effect gives a federal income tax deduction for the state income taxes paid and avoids the SALT limitation that you described. As of today, roughly half the states have adopted these proposals, but this is a fast area moving along. And it seems like every week there's another state that either modifies their existing legislation and refines it, or a new state adopts a similar regime.
Well, Tim, that's a great segue into my next question, which is initially the Department of Treasury indicated that some of the proposed solutions would not be respected. And more recently, some commentators have questioned characteristics of what states will actually work and which ones do not. So you mentioned there's a lot of activity going on within the state level. Can you share some of the insights with the group on that?
Yeah, so originally, some states have proposed mechanisms where individuals would make donations or payments to state government in lieu of paying taxes and thereby try to gain a deduction. The IRS said those sorts of regimes don't work, but they did come back and say in Notice 2020-75, they provided guidance that these so-called entity level elections that we were talking about, where the entity makes the election to be taxed, those arrangements would be respected, in part based on existing case law of other taxes that have been imposed at the entity level. There are some questions about states that have sort of an individual partner by partner opt-in election. California comes to mind. Many commentators and practitioners have been comfortable with that. Others have said those arrangements at least raise some possibility that the IRS may subsequently challenge the matters. As of today, the Department of Treasury doesn't appear very interested in pursuing these sorts of arrangements and challenging them, but who knows what a different presidential regime or the passage of time may bring.
Helpful. So it sounds like making an entity level election sounds like a great plan for most, but is that right for everyone? And then also, what are some things that really our family office viewers should consider before making such an election?
In many cases, it is a great thing and produces a substantial savings. Like all tax planning, though, one should really crunch all the numbers and look at all the facets that are involved. There are occasionally surprises where this doesn't work for everybody, or it works for some members of an organization, but not others. Usually, places that we see differences come from one of three different places. First is the manner in which the tax is computed. It's either at a different rate or a slightly different base. For example, some states will exclude things like contributions to retirement plans or health insurance deductions, and therefore you end up with a higher amount of income subject to tax. And likewise, most states impose a slightly higher tax than what would apply at the individual level. Second is with respect to in-state credits, where a state may say, if you opt at the entity level, other exemptions or credits that may apply to taxable income won't apply. Manufacturing credits, other sorts of incentive arrangements that have been put in place by states, they may be inapplicable once this is computed at the entity level. And then the third bucket is residents usually pay taxes in their home state and then get a credit for taxes that are paid to other states. Most of the newer legislation includes that if these sorts of payments are made at the entity level, the states will give the individuals credit for taxes paid in other states. For example, if I am a Maryland resident and I am part of an organization that files and pays the New York entity level tax, Maryland may give me a credit for it. But some states have not done this, where I get a credit for those New York taxes paid. For example, as of today, Maine, North Carolina, and Vermont do not give credits for taxes paid at the entity level. And correspondingly, if you have a partner or shareholder in one of those states, their tax burden can actually go up as a result of making this election. So as with all tax matters, it pays to pay attention to the details, look at what are the ramifications for all of the partners, and make sure that both in totality and individually, is this a good idea, and does this really result in tax savings? In many cases it does, and those places that it does not, obviously this is not a strategy worth pursuing.
Well, Tim, I can't thank you enough for taking a very complex topic today and trying to distill that for our viewers. I want to thank you personally for your participation today. And I also want to thank all of those that joined in our presentation today. For more information, please visit us at foley.com under Family Offices. Thank you.